While markets sleep, risk does not. Financial markets close on Friday, but geopolitics, central banks, supply chains, and liquidity conditions do not pause for the weekend. And sometimes, the most powerful price moves are born in those silent hours when traders are offline and liquidity is thin. Silver is especially vulnerable to that kind of shock, because silver does not need a gradual catalyst. It needs imbalance. And weekend events create imbalances. When something significant happens between Friday's close and Sunday's futures open, markets cannot price it smoothly. There is no slow adjustment. There is no incremental trading. There is only a gap. Silver has a history of reacting violently to surprise catalysts. Not because it is fragile, but because it sits at the intersection of monetary fear and industrial demand. If the weekend event involves geopolitical escalation, silver can surge as a monetary hedge. If it involves energy disruption or supply chain risk, industrial pricing shifts. If it involves central bank surprise policy, real yields adjust instantly. All three can move silver sharply before cash markets reopen. The reason gaps occur is structural. Futures markets reopen Sunday evening in the United States, but liquidity is thin during early hours. Large orders can move price disproportionately. When traders react to fresh headlines, price discovery becomes compressed into a narrow window. That compression produces gaps. Silver is even more sensitive because its market depth is smaller than gold's. It takes less capital to move silver meaningfully. When positioning is skewed or short interest is elevated, surprise catalysts can trigger cascades. The key question is not whether silver can gap. It is what kind of event creates sustainable follow-through rather than a temporary spike. Historically, there are several types of weekend catalysts that matter. First, geopolitical escalation. If tensions intensify unexpectedly, military action, sanctions, trade restrictions, markets reopen with risk repricing. Safe haven flows strengthen. Precious metals respond first because they are liquid, globally traded, and politically neutral. Silver tends to follow gold initially, then amplify the move. Second, central bank intervention. If a major central bank announces emergency measures, rate changes, liquidity injections, or currency adjustments over the weekend, futures markets must reprice immediately. Real yields move. Currency markets shift. Precious metals respond to those changes before equities fully digest them. Third, commodity supply disruption. Silver is heavily used in solar panels, electronics, and defense applications. If a major mining region announces production cuts, export restrictions, or logistical disruption, supply expectations tighten instantly. Unlike oil, silver supply is often a byproduct of base metal mining. That means it does not respond quickly to price changes. Supply shocks linger. Fourth, systemic financial stress. If a major bank failure, sovereign default concern, or credit market freeze emerges late Friday or Saturday, metals markets often reopen with defensive positioning. Silver may initially drop during liquidity panic, but once policy response expectations form, it can reverse aggressively. The magnitude of a gap depends on positioning going into the weekend. If speculative short interest is elevated and an unexpected bullish catalyst emerges, short covering can amplify upside gaps. If leveraged longs are stretched and bearish news hits, downside gaps can cascade. This is why silver often feels unpredictable. It is not random, it is leveraged. Now consider the current macro environment. Global debt levels are elevated. Central banks are balancing inflation control against financial stability. Geopolitical tensions remain persistent across multiple regions. Energy transition policies are increasing industrial silver demand through photovoltaic expansion. Physical premiums have widened periodically. Delivery discussions at futures exchanges have resurfaced. All of this creates a fragile equilibrium. In fragile equilibria, weekend shocks matter more. If markets close complacent and reopen to surprise, repricing becomes violent. But there is another layer: algorithms. Modern futures markets are heavily algorithmic. Headline-driven trading reacts instantly when markets reopen. Keyword detection, macro triggers, yield curve adjustments, these systems do not hesitate, they amplify early moves. Once price begins moving, stop orders trigger. Stops trigger momentum. Momentum attracts volume. Volume confirms breakout. This cascade can occur within minutes. If silver were to gap meaningfully Monday morning, the sustainability would depend on confirmation. Does gold confirm the move? Do real yields shift materially? Do mining equities follow? Do physical premiums widen further? Or does the move fade as liquidity normalizes? Weekend gaps can either start trends or exhaust them. If the catalyst reflects structural change, monetary pivot, supply shock, geopolitical escalation, follow-through becomes likely. If the catalyst is transient, rumor, temporary disruption, speculative exaggeration, retracement often follows. The reason this weekend matters is positioning. Silver has already shown volatility recently. When volatility clusters, the probability of outsized gaps increases. Markets that have been calm for extended periods absorb shocks better. Markets already stretched react violently. So what would constitute a true silver gap catalyst? A surprise rate cut from a major central bank. A sudden escalation in a geopolitical hotspot affecting trade routes. A meaningful production halt from a major mining jurisdiction. A sovereign credit downgrade over the weekend. Or a liquidity intervention signaling systemic fragility. Each of these shifts real yields, risk perception, or supply expectations. Silver responds to all three. But here's the key insight. Silver gaps are rarely isolated. They reflect stress elsewhere. Silver does not move in a vacuum. It moves when confidence moves. If silver were to gap significantly Monday morning, it would signal that something structural changed while markets were closed. Part 2 will examine whether the current setup resembles past pre-gap environments, what a true breakout confirmation looks like technically and fundamentally, and whether triple-digit silver becomes realistic if liquidity and supply stress align. Because when markets sleep, pressure builds quietly. And when they reopen, price tells the story first. The difference between a weekend spike and a structural breakout is confirmation. Silver can gap violently at the open. But whether that gap becomes a trend depends on what follows in the next 24 to 72 hours. The first thing professionals watch is follow-through volume. If silver gaps higher on thin liquidity Sunday night but volume expands aggressively during the first full U.S. trading session, that signals conviction. It means institutions are participating, not just early headline-driven algorithms. If volume fades and price stalls, the gap often retraces. The second confirmation signal is real yields. Silver is highly sensitive to inflation-adjusted interest rates. If a weekend event triggers lower bond yields while inflation expectations remain stable or rise, real yields fall. That environment is structurally supportive for precious metals. If yields rise sharply instead, silver's upside may struggle. The third signal is gold. Gold leads in monetary stress cycles. If silver gaps higher but gold remains muted, the move may be speculative or industrial in nature. If both metals accelerate together, it often signals broader monetary repricing. The fourth signal is mining equities. If physical silver gaps but silver mining stocks lag, traders become cautious. If miners surge in tandem, it suggests market participants believe the move is durable enough to impact earnings expectations. Beyond technical confirmation lies macro sustainability. What kind of weekend event could justify a lasting repricing? A central bank emergency move is one candidate. If policymakers unexpectedly pivot toward easing due to financial stress, liquidity expectations change instantly. In high-debt systems, rate cuts can ignite asset repricing quickly. Silver, being smaller and more volatile than gold, can amplify that repricing. But not all pivots are equal. If a rate cut reflects controlled disinflation, the reaction may be moderate. If it reflects systemic instability, the reaction can be explosive. Another candidate is geopolitical escalation affecting trade flows. Silver is deeply integrated into global supply chains. It is used in semiconductors, renewable energy infrastructure, military electronics, and medical equipment. If a major shipping lane is disrupted or export restrictions emerge unexpectedly, supply expectations tighten instantly. Unlike oil, silver supply cannot be ramped up quickly. Much of it is mined as a byproduct of copper and zinc production. That makes near-term elasticity low. Low elasticity plus sudden demand shift equals volatility. There is also the sovereign risk angle. If a country experiences a sudden credit downgrade or default concern over a weekend, global capital repositions rapidly. Hard assets often benefit from that repositioning. The reaction may start in currencies and bonds but spill into metals quickly. Now consider positioning. If traders enter the weekend heavily short silver and bullish news breaks, forced covering can magnify the move dramatically. Short squeezes are not hypothetical in silver markets. They are historically documented. When leverage meets surprise, price gaps expand. But squeezes are not the same as structural shortages. A squeeze can produce a violent rally that fades once shorts exit. A structural shift produces sustained higher lows after the initial spike. This is where psychology matters. If silver gaps and holds above prior resistance levels, confidence builds. Traders who miss the first move chase. Funds that require confirmation enter later. The narrative spreads. Momentum builds on itself. If silver gaps but fails to hold key levels by midweek, skepticism returns quickly. Volatility becomes mean reversion rather than trend expansion. The broader macro backdrop increases the probability of outsized moves. Global debt remains elevated. Fiscal deficits persist across major economies. Central banks operate within narrow corridors. Inflation is not fully extinguished, yet growth momentum is fragile. This environment creates sensitivity. Small catalysts produce large reactions. Another factor is liquidity fragmentation. Modern markets are highly electronic. When futures reopen Sunday evening, liquidity is thinner than during regular hours. Algorithms react instantly to headlines. Early moves can overshoot before human traders fully engage. If early momentum aligns with macro expectations, it accelerates. If early momentum contradicts macro conditions, it often reverses sharply once full liquidity returns. The $95 silver level is psychologically important. Round numbers attract attention. They become magnets for stop orders and breakout strategies. If a weekend event propels silver decisively above a widely watched threshold, technical traders respond mechanically. Technical breakouts feed fundamental narratives. Narratives feed capital flows. Capital flows sustain price, but the opposite is also true. False breakouts trap momentum traders. Rapid reversals damage confidence. So what would signal that a Monday gap is the beginning of something larger? Sustained elevated physical premiums. Declining exchange inventories alongside rising open interest. Broad participation from gold, miners, and related commodities. Falling real yields reinforcing monetary demand. And persistent macro uncertainty. If these align, triple-digit silver conversations become less speculative and more probabilistic. But caution remains essential. Silver has a history of dramatic advances followed by brutal corrections. In past cycles, rallies of 20 to 30% occurred within weeks, only to retrace sharply before resuming trend. Volatility is not a flaw in silver. It is a feature. The weekend event narrative highlights something deeper. Markets do not pause risk. They delay pricing. When pricing resumes, it can be abrupt. Silver's structure, leveraged, smaller market capitalization, dual demand drivers, makes it one of the most reactive assets when delayed pricing collides with fresh information. If nothing significant happens, Monday opens normally. If something meaningful shifts while markets are closed, silver may tell the story before headlines fully contextualize it, because silver often reacts first to stress. Not because it predicts events, but because it reflects shifts in confidence. And confidence rarely waits for scheduled trading hours. If a gap comes, price will reveal whether it is noise or narrative. And in precious metals, narrative becomes powerful when structure confirms it.